Late last week, oil futures dropped as the president confirmed productive talks with Iran over an ongoing resolution to the Strait of Hormuz. But of course, sure enough, at a new record pace, just 3 hours later, there was a fresh wave of strikes on tankers, causing oil prices to bounce back up again and end the week higher. As a surprise to absolutely nobody, this also happened just 15 minutes after financial markets closed. A week before that, talks were set up in Doha, prices fell. 6 days later, the talks were called a waste of time and prices rose. A week before that, prices were pushed down on positive announcements of great progress in negotiations, and then rose again when that too fell apart. Prices rose, prices fell, rose again, fell again, rose again, fell again just after a conveniently timed trade, rose again, and this has all happened at least a dozen times as of when this video is published. Oh, and side note, in the 3 days that it has taken me to write this script, the war has apparently been resolved and renewed another 2 times. Which is kind of a little bit embarrassing, right? And I mean, not just geopolitically embarrassing, but also financially embarrassing. These oil futures markets manage billions of dollars every day in one of the world's most vital resources, and are apparently run mostly by massive institutions with teams of highly skilled analysts at their disposal to piece together information you and I just don't have access to. Which does raise a pretty obvious question. How many times are these oil markets going to keep falling for this? If we are being incredibly generous, all of these announcements have clearly been premature. Realistically, it's fairly clear that some level of market manipulation is going on here, with several instances of significant trades being placed just minutes before major market movements. So, why are these supposedly highly informed, highly sophisticated market participants still following along with a pattern that basically everybody can see? Oh yeah, and I guess we should probably also look at why oil prices are just going ahead and falling anyway.
The U.S. and Israel unleashed a massive joint strike on Iran.
First time in history, Iranian officials say the country has closed the Strait of Hormuz. The U.S. and Iran have agreed to a temporary 2-week ceasefire.
President Trump cancels the U.S. delegation's trip to Pakistan.
President Trump says the U.S. Navy will begin blocking Iranian oil shipments in the Strait of Hormuz today.
Now, President Trump is in Europe for the G7 summit, where he's talking about a signed memorandum agreement to end the war in Iran.
Iran has once again disrupted traffic in the Strait of Hormuz, carrying out a drone attack on a container ship.
One of the most notable comments that the president made, though, came at the end when he was asked if the ceasefire with Iran is over. And he said, "I think it's over. They are scum. As far as I'm concerned, it is dead."
U.S. Central Command said they hit dozens of targets aiming to degrade Iran's ability to continue attacking international shipping flowing through the Strait of Hormuz.
Okay, so there are a few reasons why, despite very clearly being meaningless at best or manipulation at worst, oil futures specifically are almost forced to play along with this geopolitical hokey-pokey of announcements. The first is that these are real markets, with real participants who actually have real operations that depend on the price of oil. This might come as a surprise to a lot of people, but commodities futures markets are actually not built from the ground up to be a casino of speculation. They do, in theory, serve a real purpose. Oil futures markets like West Texas Intermediate and Brent are there for real businesses to lock in prices for, well, the future. This is useful for actual participants like oil producers and shippers because they can be sure of the price they will get for goods and services before they deliver them. And on the other side, it's also good for refiners because they can lock in a fixed quantity of this input at a fixed price. Now, I'm not going to do the full derivatives deep dive, but oil futures, unlike a lot of purely financial options and futures, are actually physically settled. So, if you hold an oil future on the day of expiry, you physically have to make arrangements for it to be delivered. As the name would, not suggest, if you hold a West Texas Intermediate futures contract at expiry, that crude oil is going to be delivered to you in Cushing, Oklahoma. This is basically a big field of oil storage tanks at the crossroads of some major oil pipelines that also happens to have a small town attached to it. Obviously, for actual refineries, that is the whole point. They want actual oil to feed into their facilities. Now, normally, only about 2 to 3% of futures contracts ever end up getting physically delivered. Most participants close their positions or roll them forward before expiry. If you agreed to sell me a barrel of oil on the 30th of February 2027 for $100 and then a day beforehand, oil was trading for $140 a barrel, it's possible that we both figure out that none of us actually want to deal with that random barrel. So you can just pay me the $40 difference I would have made by actually selling the barrel on Facebook Marketplace. Now, replace two random nerds with the entire worldwide speculative commodities market, and Facebook Marketplace with Cushing, and that's kind of what happens here. But the fact that they can be delivered is what, in theory, keeps the futures price tethered to reality. If you were an actual oil producer with a barrel in hand, and I couldn't find anybody else to buy this barrel for me, I would have to take it, and also deal with the costs that come from properly storing what is still a very hazardous chemical. In April 2020, WTI futures briefly fell to negative $37 a barrel. COVID meant that people weren't using as much oil, and Cushing was running out of room to store the excess. This led to traders literally paying people to take their contracts rather than accept the physical delivery of oil they had nowhere to put. Now, because these participants have physical operations that depend on delivering or receiving consistent supplies of crude oil, they are exposed to anything that could disrupt their supply chain. For a refinery that actually needs crude delivered to its facility, playing along with an announcement about the strait reopening or closing again is not so much something that they choose to do as much as it is something that they kind of have to accept, even if the last 12 announcements have turned out to be noise. These groups are mostly what are called price takers. They take what the markets offer, because their core business is producing, refining, shipping, or retailing fossil fuels, not speculating on price movements. They are also exposed to things like how much the government taps the Strategic Petroleum Reserve, and how much downstream buyers are panic shopping for fuel, so again, they just kind of take it. Now, you might reasonably expect the price of a barrel of oil at some point in the future to be worth roughly as much as a barrel of oil today, and most of the time this is true, but not all the time. In April of this year, the difference between this real market and the futures market grew to its widest level in decades. Especially for Brent, which is physically delivered in North Sea terminals and is more exposed to Middle Eastern and Asian markets, the difference between the futures price and the price to actually buy real oil then and there was as much as $40 a barrel. Now, that has since come back down for reasons we will discuss later, but the point here is that the speculators that were just trying to make money by predicting where oil prices would end up in the future were collectively kind of assuming the disruptions were overblown. But the actual oil consumers just had to pay whatever was being offered for the crude that was physically available. Now, I know all of this is a bit abstract, but the point is that these markets are kind of stuck between a rock and a dumb place at the moment. On one hand, the firms that actually need crude oil as an input into their business operations can't accept the catastrophic risk possibility of just not having supplies available to them, so they pay what they must. On the other hand, speculators don't want to be exposed to the catastrophic risk that oil starts flowing again and they get stuck holding deliverable oil futures that nobody wants to buy, and they end up needing to pay someone to take it off their hands. It's a dumb game. The only winning move is to not play. And well, that's exactly what's starting to happen. So it's time to learn how money works to find out why people are starting to ignore the oil market and why prices are falling anyway, despite one of the biggest supply disruptions in modern history. This video is sponsored by Upside. Gas prices keep climbing, groceries cost more every trip, and eating out isn't getting cheaper. But what if every time you filled up, grabbed groceries, or went out to eat, you were earning cash back on all of it? That's what Upside does. It's a free app with over 100,000 locations where you earn cash back on gas, groceries, and dining, the everyday essentials you're already spending money on. Here's how it works. You open the app, claim an offer near you, pay with any card you want, and you get paid. No points, no credits that expire, cash back you can actually use deposited straight to your bank account, and it stacks with whatever credit card rewards and loyalty programs you already have, so you're not replacing anything. You're just getting more for your dollar on things you already buy. I use this, and if you're watching this channel, you probably should too. Upside has given back $1 billion to its users. To find out how much you could earn, download the free Upside app and use promo code HowManyWorks to get an extra 25 cents back for every gallon on your first tank of gas. That's an extra 25 cents for every gallon on your first tank of gas using promo code HowManyWorks. Scan the QR code on screen or click the link in the description to get started. Now, the real market participants being forced to play along with the flip-flop oil war does kind of make sense. But the second big problem is that the speculators who normally cushion this market have kind of just given up. Derivative traders like to make this sound more complicated than it is, but in normal times, these two groups do technically each have a role in this market. Actual oil suppliers and consumers who are happy to forego speculative profits to avoid risk and locked-in guaranteed prices, and speculators who are happy to accept the risk of fluctuating prices to try and make speculative profits. So this whole market is just what the finance bros like to call a risk transfer mechanism. Oil futures don't actually produce anything. They are just a contract. So the only way to make money on them is to sell them for a higher price than which they were bought. Despite being a zero-sum game, this is still a massive market, with institutions that spend tens of millions of dollars doing advanced research to find slight pricing discrepancies between the market and reality. The classic example is that some of these firms do crazy things like launch their own imaging satellites to track oil production, count the number of tankers sitting at anchor, and monitor reflections off crude storage tanks to estimate how full they are, all to gain a slight edge over the market. Other firms just go all in on trading speed, so they can react to news a thousandth of a second before everybody else does, which has also contributed to the market's knee-jerk reaction to news, because it often is a reaction that is processed before any real humans actually realize what's going on. This can be very lucrative, but that trading edge is now being evaporated by the far less predictable announcements surrounding this war. It's a little bit like someone counting cards to gain a slight advantage at the blackjack table. If they are very smart and collect the right data, in a fair game, they should be profitable over the long term. But if the dealer is cheating by throwing cards to their buddy at the same table, well then all that hard work is basically pointless. A desk of PhD analysts could synthesize terabytes of proprietary data to eke out a few basis points of alpha in a normal market. But in this market, all that effort can be wiped out by somebody who got a heads up 15 minutes before a tweet went out. Again, for the speculators, this is a zero-sum market. For that miraculously timed trade to win, someone else has to lose, so a lot of them have just been choosing not to play. Typically, speculators are attracted to markets with a lot of volatility, and this did happen at the beginning of the war as big swings meant big opportunities for speculative profits. But trading firms have, understandably, started seeing this as unacceptable risk and have pulled back. According to data from Saxo Bank, net speculative open interest has dropped towards a 16-year low, with the only exception of August last year, at a time when typically we would expect more market activity. Now, I know what you might be thinking. A bunch of hedge funds can't make money because the market is rigged against them? Outside of glorious irony, who really cares? Well, unfortunately, this matters because, in theory, these firms serve the function of price discovery and providing liquidity between the suppliers and the users. They were obviously doing this to seek their own profits, but in doing so, they cushioned the market a bit. They absorbed some of the volatility that would otherwise land directly on the actual oil companies that just wanted to offload the risk of oil price swings. Without the risk accepting speculators, these actual participants are left absorbing more of the price swing directly, which means the market has less capacity to absorb shocks, and even a moderately sized announcement can move prices further than it should because there are fewer counterparties willing to take the other side and call these announcements out on their bluff. Now, for the record, I just want to say that even with the exodus, the vast majority of futures trading is still done by speculators. But the ratio of price takers to risk acceptors really matters. Going from 2% to 5% of the market being physically settled might only sound like a 3% difference, but in reality, it's actually more like a 150% difference in market buffer. The third factor that really needs to be acknowledged is that this war has become very politically sensitive. There are really three regimes staking their reputation on how much they can control the other two, and a big part of that control depends on where this price line sits. All of that is to say that, just as much as announcements around this war have influenced movements in the price of oil, movements in the price of oil have also influenced these announcements. So yeah, it sounds dumb, and it is dumb, but there is actually some good news in all of this. Despite everything I have just said about the market being more exposed, it is still slowly starting to ignore all of these dumb headlines. Obviously, there has been a lot of noise back and forth over this war, and this is by no means going to be perfect. But, as best as we could, we actually looked at all of the major announcements we could find saying the war would be coming to an end, and announcements that the war would be escalated, and then line them up with their respective daily movements in oil prices. And well, the impacts are clearly declining. Again, obviously this isn't perfect. I can only subject Harry to collecting so many, data points as punishment for his crimes. But in the early days of the war, a tweet about bombing Iran back to the Stone Age made oil prices rise by 8%. In late June, there was a similar post about new strikes on Iran infrastructure, and the market just totally ignored it. Prices actually fell slightly. On the flip side, peace talk announcements in April saw the biggest single-day drop in oil prices outside of the pandemic. But last month, the Memorandum of Understanding, the one where we would give Iran a $300 billion fund, only pushed prices down by 2%. And a similar reversal of logic, early this month, an announcement of the Qatari deal going well also actually pushed prices up. Now obviously this is not absolute, and real actions can still push prices around. Just this past Tuesday, Iranian strikes on tankers sent Brent up 3%, and then the ceasefire was declared over and prices climbed again. But the general trend is that the market is taking the words from both sides less and less seriously with every false start. Oh, and there is one more thing. Not only is the market taking these press releases less seriously, it also just seems to be taking the war less seriously as well. Despite no real progress towards a long-term solution, prices are basically right back where they were when this conflict started, which does raise the obvious question of why? Well, this is the part of the video that has the potential to really not age well, but for now there are a few reasons. One is that the world is simply just consuming less oil. People have responded to the increased prices by using fewer fossil fuels by an estimated 1 million barrels a day. China in particular, the world's biggest net fossil fuel importer, has seen its crude imports drop to an 8-year low of roughly 7.8 million barrels a day as of May. China has gone big on EVs and alternative energy sources. Electric vehicles hit 62.9% of new car sales in China in May, and in the first week of June, that number hit a record 66.7%. Among domestic Chinese brands, the EV share is now 81%. In China alone, EVs displaced roughly 1 million barrels of oil demand per day in 2025, and that displacement is growing by about 600,000 barrels per day every year. Sinopec, China's biggest refiner, now says gasoline demand in China actually peaked back in 2023, and diesel demand peaked in 2019. Chinese consumers are also more price sensitive than richer households in the West. So even if they don't have an EV, when oil gets expensive, they respond faster than a typical American family with a higher disposable income to tank the price bump. This trend with the biggest oil consumer on the planet is scaring a lot of producers into ramping up supplies and selling now, because if this shift can happen in China, the rest of the world may not be far behind. OPEC Plus has been raising output quotas, adding roughly 2.9 million barrels per day during 2025, with another 800,000 approved so far this year and 188,000 more just approved for August. The IEA is now predicting a surplus of 3.84 million barrels per day this year, potentially approaching 4 million. The second thing to remember is that the price being quoted here actually refers to oil delivered to a specific location at a specific time. A lot of the market is concerned that the buildup of oil stuck behind the strait could all come out at once and lead to a massive spike in supply, putting oil facilities above capacity even if the oil would eventually find its way to real consumers. There is also just speculation about the midterms. Oil prices were one of the big factors in the last election, and both sides of the conflict as well as both sides of the election know it. The government has not been subtle about trying to bring prices down before voters start paying attention. The 60-day sanctions waiver allowing Iran to sell crude through August was widely described as having some, domestic political advantages. Research from the Belfer Center found that every 1% increase in crude oil prices 12 months before an election reduces voter intention to re-elect the incumbent party by roughly half a percentage point. On top of all of this, there is the fear of one of the most outlandish economic proposals I have ever heard, and that is that countries may just go ahead and short the market themselves. It hasn't happened yet, and it may not happen at all, but it's so interesting that it's worth talking about. About 3 months ago, Japan floated the idea that it could use its $1.4 trillion in foreign currency reserves to short oil futures. So, why would they do that? The idea is that its own currency is falling compared to the US dollar, and it wants to stabilize that slide. Almost all global oil trade is done in US dollars. By shorting oil prices down, it would theoretically mean people would need fewer US dollars to settle their oil deals, which would reduce demand for US dollars in international forex markets, which would in theory reduce the value of the US dollar relative to the yen. Now, yes, of course a big short like this means that in theory, they might be exposed to a GameStop-style squeeze and be forced to buy back all of that oil. But the thing is, they were going to buy it anyway. Japan imports more than 95% of its crude from the Middle East. So when oil surges in dollar terms, Japan has to buy massive amounts of dollars just to pay for its imports, which directly weakens the yen even further. Finance Minister Satsuki Katayama blamed speculative crude oil futures moves for disrupting exchange rates and said the government is determined to take thorough action at all times and on all fronts. It's kind of insane, and again, it hasn't actually happened. Honestly, the only reason I bring it up is because I thought it was the most crazy harebrained scheme I have ever seen seriously proposed on this kind of economic scale, so I wanted to yap about it. Now, if you want further proof of just how long markets can ignore reality, go and watch this video next to find out why economic crashes never seem to happen on schedule. And don't forget to like and subscribe to keep on learning how money works.